This is a recording with examples of a cash dividend and a stock dividend. So this first example, well, actually it's one problem and it does have an example of a cash dividend and a stock dividend. So for this problem in 2017, we have a company. This is the stockholders equity section. So we have common stock. There's 100,000 shares that are issued and outstanding. We can get the number of shares by taking the dollar value of the common stock, dividing it by the par value. So $1 million divided by $10 gives us 100,000 shares. So if they had not told you this number here, how many shares were issued and outstanding, so if they just told you it was $1 million and $10 par, you could divide the $1 million by the $10 par and come up with the shares issued, and you would know that was outstanding because there's no treasury stock reported here in the owner's equity section. So if this, for example, had told you there were 200,000 shares authorized, you would just ignore that when you're doing these calculations. That's just telling you the maximum number of shares that can be issued. So on January 15, they're declaring a $1 cash dividend. So a cash dividend means that they will be writing checks to the investors. So the first thing we need to figure out is what is the value of the checks that will be written. So $1 per share. So we have 100,000 shares outstanding, and it's only the outstanding shares that get a check. So 100,000 shares times $1, so it'll be $100,000. So it will be a debit to cash dividend. So this is the account that actually will be closed to retained earnings, and then dividend payable, because at the point in time that the dividend is declared, a liability of a payable account is set up because we have an obligation to make the payment. On February 15th, the dividend the dividend is going to be paid. So hold on. Sorry, I didn't mean to cough into the microphone. So on the 15th, we're going to make the payment. So the dividend payable is going to be settled, and we're paying that with cash. That's because it's a cash dividend. So we're going to settle with cash. So the next screen, we're declaring a 15% stock dividend. So that means we're going to distribute stock. So there should be no cash showing up anywhere in this transaction because it's a stock dividend. We're giving them shares of stock. So for every share of stock that is existing, they're going to get 15% of a share of stock. So to do this calculation, we take the 100,000 shares and multiply it by 15%. So we're going to issue 15,000 shares of stock. And because this is a small dividend, we issue those at market value. Okay, so the dollar value of the issue is $225,000. That's the value of the issue that is going to be made. So to record this, there is a stock dividend. This will be closed to retained earnings at the end of the year. So the value of the stock dividend is $225,000. When we record this, we have to show it in the stockholders equity section. Notice no cash. Okay, no cash, because it's a stock dividend, because we're going to be distributing to the investors who own shares of stock more shares of stock. So we're reporting that they're going to have distributed to them in the near future shares of common stock. So there is a stock dividend distributable. So there's 15,000 shares, and we record stock at the common stock at par value. So the 15,000 shares at par value are 150,000, and the balance of the 225,000 goes into paid in capital in excess of par. So this has to balance to the 225,000 that we've got as the value of the stock dividend. Okay, so you always have to have your debits equal your credits. You should always be checking that. I can't tell you how many times people have points taken off on their exam because they didn't check that their debits equal their credit. Hold on. Okay, so on May 15th, we're going to issue those shares. So this common stock dividend distributable is being distributed, and now there's just common stock out there. So the common stock is not, you can't pay dividends on this, you can't pay cash on this until it's actually distributed. So between April 15th and May 15th, that stock isn't out there, so they cannot sell it to someone else, but they know it's coming to them. That's why it's called common stock dividend distributable. They don't really have that stock in their little hot hands, and they can't sell it to somebody else until they actually have it on May 15th. So they know they're going to get it April 15th, but they can't do anything with it until they actually have it on May 15th. But it's been promised to them on April 15th, so they have an obligation to deliver it as of April 15th. They can't back out of it, but they don't actually get it and have ownership of it until May 15th. That's the difference. And then on July 1st, they do announce a stock split. So a stock split, all it does is double the number of shares they have, and it halves the par value. So there's no entry. We just got to make a note. So the par value used to be 10, now it's 5. So the number of shares authorized, the number of shares issued, and the number of shares outstanding are half as many. So before we had 115,000 shares, now we have 230,000 shares. So you got to keep track of that. On December 1st, we're going to declare a 50-cent per share cash dividend. So cash dividend, we're actually going to pay cash. So we're going to write a check. So first thing we got to do is figure out how much money. So we had 100,000 shares when we started. We did a stock dividend, so we issued another 15,000 shares. And then we did the stock split. So we have 230,000 shares outstanding, and we're going to pay a cash dividend of 50 cents per share. So the cost of this cash dividend is $115,000. So cash dividends, which will be closed to retained earnings at the end of the year, and dividends payable. So we have a liability at this point. And when we make the payment, so on January 10th, when we're actually going to send the checks out, we will debit dividends payable and cash will be credited for $115,000. The last entry here, they're telling us the net income was $250,000. So as part of the closing entries, we would have income summary, which would be debited for $250,000, and retained earnings would be credited for $250,000. As part of the closing process, the cash dividends would be credited, retained earnings would be debited, and that stock dividends would be credited and retained earnings would be debited as well.